Hear the word hedge fund, we always think of risk, 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 right? And we think of it as a risky bet. We think of it as highly speculative and meant only for those who are risk aggressive, etc. But what are the risks that a hedge fund faces? Let's learn more. I'm your learning partner, Sushila Hariharan, and if you're interested in a career in global markets, investment banking, and hedge funds, do subscribe to this YouTube channel where we provide content centric, research focused videos on these topics related to equities, bonds, and currencies. What are the risks that a hedge fund faces, exposed to, right? Let's analyze this in greater detail. The hedge funds are exposed to four types of risks. And I'm going to arrange them not in any particular order, but in the order of how they operate and in the context of the strategy at which they are operating. For example, a macro hedge fund is exposed or faces different kind of risks compared to, let's say, a bond fund. Okay, so let's start with the first, which is credit risk. Credit risk is the risk that the counterparty defaults and therefore the hedge fund has to incur a loss because of the default. Remember, hedge funds are big players in the OTC derivative market. Derivatives, as we know, are financial assets whose prices are derived from the prices of the underlying asset. So we have exchange traded derivatives like futures and options, and we also have OTC derivatives like forward contracts and exotic options, as well as interest rate swaps, currency swaps. The list is endless. The OTC derivative is defined as one which is not traded on an exchange, and therefore the trade itself doesn't take place on a centralized trading platform, but the settlement takes place between the counterparties in a centralized settlement mechanism. OTC derivatives are directly entered into between two counterparties, which is in a bilateral manner, and because it's a bilateral contract, the counterparties take a direct counterparty exposure to each other, and this counterparty exposure results into the fact that the hedge fund could face some loss in case there's a default, but more or less nowadays that is very, very minimalized because of the centralized clearing counterparty, which is the clearing house in many of the countries. The second risk that a hedge fund is exposed to is called as market risk. Market risk is the risk that as the asset prices are very, very volatile in the markets in which the hedge fund is invested in, the hedge fund could trade in losses. For example, we have seen for a sustained period of almost 1.5 to 2 years, the Japanese markets were underperformers, and hedge funds which had aggressively invested in Japanese markets in Tokyo Stock Exchange or in Osaka Stock Exchange found that they were not necessarily making much returns despite having committed large amount of capital into the country. So we have market risk, that is the risk that the prices move against the portfolio exposure of the fund. For example, let's say the hedge fund is long on equities and global market prices crash. The market risk faced by the hedge fund is the loss on the equity portfolio. The hedge fund is extensively invested in this macro hedge fund is extensively invested in emerging market bonds, for example, and as interest rates decrease, the bond prices will increase, which is very good for the bond investors. But if the hedge fund is short on bonds, then it is obviously going to take a loss. So market risk is the risk that asset prices move against the trading position. Now, we often hear the statement, it comes across on all mutual fund advertisements, that is, all investments are subject to market risk. Please read the offer document carefully before investing. What does this mean? This means that investments that the fund is investing in has volatility in prices. If there is no volatility in prices, there is no market risk. Okay? So this is a very important aspect of understanding market risk, that is, as prices increase or decrease, it affects the trading position and the portfolio profit of the hedge fund, and hence there has to be some bit of acknowledgement of how do we calculate and quantify this market risk. Most funds will therefore adopt a strategy of marking to market, that's MTM, M2M, MTM, marking to market, the outstanding positions on a daily basis, so that they understand what is the profit or loss albeit notional, on their portfolio. So this enables the hedge fund to remain in control of its portfolio and also do a very strategic asset allocation the very next day. So every hedge fund, because it's trading in marketable securities across different currencies, across different asset classes, across different markets, will be exposed to market risk. The third risk is liquidity risk. Liquidity risk is the risk that the hedge fund is not able to meet its commitments or obligations on time. Generally speaking, this is not very high in a hedge fund as much as it is in a commercial bank, but that doesn't mean it doesn't exist at all. This is largely because hedge funds take a large amount of capital from small investors, and they therefore keep some bit of liquidity for meeting these kind of exigencies. Moreover, since hedge funds take capital from large amount of capital from few investors, if one of the investors wants to pull out of the hedge fund, then it will be a very significant amount of money. I mean, look at some of the investors investing into hedge fund contribute in excess of $50 million, $60 million into the hedge fund. And if they want to withdraw from the hedge fund for multiple reasons, then the hedge fund has to liquidate its assets, and only then it will be able to pay back the investor. So the hedge fund thus runs a larger risk in terms of liquidity compared to, let's say, a mutual fund, because in a mutual fund we have the risk which is spread out and diversified over a larger number of investors. So that doesn't typically happen. If one of the investors withdraws their capital, it's not going to create such a big dent for a mutual fund as much as it could create for a hedge fund. And the fourth one is common errors and mistakes, totaling up to what is called as operational risk. If you don't have the right systems in place, you are not able to capture the right trade details, you don't have a strong support team for doing your reconciliation and account balancing, etc., then you're exposing yourself and the investor's assets to theft, to forgery, etc. That is really not just done. So hedge funds also have risk management and compliance in place, because like every other financial institution, they are also exposed to all the four risks, that is credit risk, market risk, liquidity risk, and operational risk. So if you think hedge funds are just risky places, no, they also are exposed and they also face a significant amount of risk because of the nature of their activities. Thank you so much.